And welcome back to our session on working capital management and advanced corporate finance. In the last session, we have talked about how do we estimate the working capital requirement of for a company, and we have done one sum in regard to this, and we will do another sum. All right, and right here, this is an example too. The following annual figures relate to XYZ company, and the sales total value of the sales for the year is 3.6 million, and material consumed, suppliers extended to 2-month credit. So when we consume, so when we purchase material, so suppliers has grant us 2-month period to settle the amount. When we make sales on credit terms, so we allow our customer 2 months to settle the money. And the wage in its regard to the labor, direct labor, and we settle the labor charge in 1 month. The cost is 720,000. And cash manufacturing expenses, not that here cash manufacturing. Cash manufacturing expenses, so expenses are paid on 1 month in arrears. It means the manufacturing expenses are paid the same in 1 month. That is 960,000. And administrative expenses, 1 month lag in payments. It's also we have to settle in 1 month. That is 240,000. Sales promotion expenses paid quarterly in advance. So it's advance payment, right? So it's an expense, but we have to consider it is as a current assets because it's a prepaid expenses, right? So we have to keep paid in quarterly, right? 20,000. And the company sells its products on gross profit of 25%. So their profit margin is 25 on sales. Depreciation is considered as a part of cost of production, right? Cost of production, the 25% of the cost includes depreciation also. And it keeps 1 month stock each of raw materials and finished goods, and cash balance of 100,000. Assuming a 20% safety margin, and compute the working capital requirement of the company on cash cost basis. And here, very interesting things, they instruct us to ignore the work in progress. Have you give a try on this? I'll give you 2 minutes, and you can grab an idea on this. Please get an idea on this sum. Please have a try on this. Creditors, how much credit? Yeah, creditors, and what are those? Wage payable, and admin expense payable, and what else? Right. So these are the things very important to keep. And so how do we calculate raw material? Any idea from you? How do we calculate raw material? So here they are giving us annual figure. In the previous example, they have given us number of units to be produced and unit cost. But in this sum, they have given us a total cost. So it make our work easier. So we don't want to calculate the cost again. They have directly given us. So therefore, annual material cost, how much? Annual material cost, it's equal to 900,000. Annual cost is 900,000, and they are we have to keep raw material for about 2 months. So therefore, we have to divide by 12 and multiply by 12 or 2 months, right? Right. How much? How much? It's about 150,000, right? Correct? 150,000. And what about finished goods? Finished goods. So we have to find the cost of the finished goods, right? And we have to do a working on this, right? Uh, Value of finished goods. Finished goods consist of what? What are the cost elements? Raw material, and here wage, labor charge, and are there any overheads? Companies, sales, material, wage, cash manufacturing expenses, right? Manufacturing expenses. Admin cost it is not part of product cost, and the sales promotion cost also it's not a part of product cost. Here raw material cost. How much raw material cost? Here 900,000 annual cost, and wage cost. Wage paid 720,000, and cash manufacturing expenses are paid in 1 month, right? 960,000, right? Then how much total? Then it's equal to 200. So it's a value of finished goods, right? And right, then can we keep this for how long? Finished goods, the company sells its product on gross profit, depreciation is considered, keeps 1 month stocks in raw material and finished goods, right? And finished goods we keep the company keeps for uh, 1 month. So therefore we take total cost as 258,000. 58,000. This is for annual cost, and we divide by 12 into 1 month, right? Here the raw material also the company keeps 1 month, no, not 2 months, isn't it? Have you understood? Here the calculation is wrong. The raw material it keeps 1 month stock of each of raw material and finished goods. Therefore, it should be 1. It should be 1. 75,000, right? And this is equal to 215,000 finished goods. If you have any doubt, you can stop me, and you can ask any questions if you have any doubt, right? And what else? What else? Next one. And receivable, isn't it? Receivable, how much? To find the value of receivable, again we have to do a work on this, and right, this is a value of finished goods, and we have to include this also. Yes, a current question, and so we have to take this one, admin expenses. Admin expenses, how much? 240,000, and sales promotion expenses. Promotion expenses, right? How much? 120,000. Then we will get a cost of sales. Right, cost of sales, then how much? Then it's equal 280 or so, and that figure 120,000, right, 294,000, and so this is so how to calculate? So annual sales cost is 294, 93, and it is for 12 months. And how long?
Excuse me, sir.
Yes.
Some students can't join in this link, sir.
Okay, no issue. And if you have any questions in this sum, please stop me and ask. Right? Other issues we will talk about later. Okay. And here, how much we keep? How long? How many months we allowed our customers to settle the payment?
2 months.
Very good. Yes. Then 400, 940. 1, 2, 3, 4. Yes, right. And how much prepaid expenses? Prepaid expenses. It's 1 month, no? Sales promotion expenses paid quarterly. Quarterly mean how many months? Quarter mean how many months? A quarter?
4 months.
4 months. No, 4 months mean it should be 16 months in a year, right? How many months? Quarter, 1 quarter. So altogether 12 months. So we divide by 4, a quarter equal.
3 months.
Very good. And how much sales promotion expenses equal 120,000, right? This is for 1 year, and we have to divide by 12 to get 1 month figure, and we have to keep we have to get 3 months. So it's equal 3,000. So how much? 120. Yeah, right. It's equal 30,000, right? And how much cash balance? Cash balance? How much? Any answers? Cash balance is given. That is how much?
1 lakh.
It's 100,000, right? 100,000, right? Now, how much gross working capital now? Gross working capital equal the sum of, right, sum of this figure. And under the current liabilities, we have to calculate, yeah, then how much, how creditors arise, how, when we purchase raw materials on credit basis, the creditors will arise, right? So we have purchased raw material, how much? Annual cost? Annual cost of raw material is 90,000. So not 90,000, 900,000. And it is for 12 months. And to get 1 month figure, we divide by 12. And so how many months our suppliers given us to settle it?
2 months.
Good, 2 months. Then it will 150,000, right? And wage, what about wage? Wage. So annual wage cost is 720,000. We divide by 12 and we settle the wage in 1 month. So, right, it's equal 60,000. And admin expenses also settled in 1 month. So the annual cost is 240,000 and split in 1 month. So therefore, it is equal to 20,000. Right, and right. Now, further there says assuming a 20% margin, right? 20% margin means sometime due to some reasons, the case requirement may be fluctuate. Case requirement may be fluctuate, and this time they have to manage their business. So therefore, for the safety needs, they are keeping some number of margin. So that is equal to 20%. So for calculate that safety margin, we have to get the net working capital, right? Net working capital, here total liabilities. How much total liabilities? This amount is a total liability and the total current liability, right? Total current liability. And how much net working capital? Net working capital equal gross working capital minus current liabilities, right? And we will get 680,000 or so. Right. And again, yes, and we have another thing. Yes, manufacturing expenses. We have missed this one, right? Cash manufacturing expenses equal 960,000. We have to include also as a as what? You have to include one. Insert. We have to miss it. We have missed. Right, that's what cash manufacturing expenses. Manufacturing expenses. How much annual cost? Annual cost 960,000 divide by 12, and it is settled in 1 month, right? 80,000. Then how much net working capital? This sum. Net working capital 600,000, and now we calculate the margin, safety margin. Safety margin is 20%, no? And 20% of this. $120,000. And how much working capital requirement? Then how much working capital requirement? And the working capital requirement is net working capital 600,000 plus $720,000, right? Any questions to ask in this regard, Sam? Any questions? Any questions, please? If you have anything you are unable to understand at this moment. Any questions? Right, then we will move to the next section. Right. Yes, this is an example too. So it is nothing new. You have a look at on this. This is a very simple question when compared with the sums we have did for a while and the last session. Please have a look at on this. It's very simple, right? Very easy in sum, and we can do it with your own efforts. And this is also the same, right? And we have more areas to cover. So example 3 also does not have anything new, so you can do it by yourself. And this is a little bit tricky, right? Can you do it, this one? Can you do it? Example 4. Can you do it? It's about cash budget. Can you do it? Right. Please give a try, so we don't waste our time here. You have a try with your own. If you're unable to do so, if you request, I will do it in online session, right? Little bit tricky. You have to think a little, right? And so you keep it as a homework, take home assignment, and if you have any trouble, I will do it in online session. And we move. Yeah, this is also to you. It's about cash budget. And have you studied cash budget in previous semester in other subjects? Have you studied?
Yes, sir.
Okay, then it is very easy to you. and you also, this sum also can be done by you without any trouble. Very simple basic questions. And now we move to the next section in the working capital management, that is cash and liquidity management. It's cash and liquidity management. As we know that the cash and bank balance is the most important and highly liquid assets in an organization. It is very important to manage to run the business in an effective way. Right. Right. The session objectives: understand the various reasons for holding cash. So we have to understand why people, why corporations, why companies keep money in their hand, and explain and apply both BAT model and Miller on R model. So both of these models are very famous models to manage the cash balance. And it's like EOQ, no? EOQ. What do you mean by EOQ? Have you studied EOQ in inventory management? EOQ. You may probably study it in cost and management accounting. What do you mean by EOQ? Anybody of you? What is EOQ? No idea. EOQ. You might study it in from AL onwards. What do you mean by EOQ? MG29, can you tell what do you mean by EOQ? Right or wrong? Don't worry, you just tell your idea. MG29.
Total quantity at the lower holder cost and
No,
order cost.
I don't want to ask the meaning. What do you mean by the abbreviation EOQ? What do you mean by E and O or Q? Nobody.
Economic order quantity.
Very good. Economic order quantity, right? The same principle will be applied in BAT model, and in the Miller and O model we will use some statistical techniques, right? Say like standard deviation and variance, spread, that kind of stuffs we have to apply in Miller and O model. But the BAT model is like calculation of EOQ in inventory, right? So it's not a big deal here. And explain what float is and the different type of float, and discuss various ways of managing float. There are some delays uh, when we collect our money from our customers. So there are some delays to realize the money. So how do we manage that kind of floats? And outline ways that firms overcome temporary surplus or deficit of cash. Sometimes the companies, business organizations having surplus money, they are keeping money more than what they want, and sometimes they are facing some troubles without having sufficient money to run their business. And finally, you have to discuss the role of various regulators of financial market. Our focus mainly on here on securities market, right? Securities market, and also in the bank too. Right? Finance students, as a finance students, we have to focus more on capital market, that's Colombo Stock Exchange, and both equity and debt market, as well as we have to focus on the government bond market and treasury bill market. You have to have a big clear idea on this. Right. So why do people holding cash? Why do people holding cash? Why do a business organization holding cash on hand? Why? Why do they keep cash? So first one, the speculative motive. Speculative motive. So it's mean the need to hold cash to take advantage of additional investment opportunities such as bargain purchase. So some people are having, not some people, the business organizations are always looking for an opportunity to make profit, and to grab that opportunity, business opportunity, they have to keep money in their hand. Once the opportunity comes, they will capitalize it. For that, they want money in their hand. And precautionary motive. Precautionary means it's kind of what, safety, for safety reason. For safety reason, suddenly you need additional money, right, to manage your business. So for that purpose also, you have to keep some amount of money in your hand. The need to hold cash as a safety margin to act as a financial reserve. And the third one is a transaction motive. So to run the day-to-day business activities, they have to keep a sort of amount of money in their hand, such as paying bills, paying telephone bill, paying electricity, buy and selling of inventories, right, settle the money to their suppliers, right. So for that purposes, the need to hold cash to satisfy normal disbursement and collection activities associated with a firm's ongoing operation. And finally, a compensating balance requirement. Compensating balance requirement means most of the business organizations are keeping a bank account in their banks, right, in their banks where they keep bank account, and the bank requires a certain amount in their bank account, and the the customer unable to withdraw that money, right. So for example, if you open a bank account, individual account for your personal account in commercial bank or other banks, so they are maintaining, they're required to maintain minimum balance as 500, right. Some banks are wanted to keep 1000, right. So you can't, if you want money, you can't withdraw that money. If you want to withdraw that money, you have to close the account. So for that purposes, you have to keep a certain amount of balance in the bank account. That is called compensating balance requirement. It means cash balances kept at commercial bank to compensate for banking services the firm receives. And anything to ask in this? Okay. And the target cash balance. Why do we study about cash management? So first we had to set the target, right, a target balance of money, target balance for cash. So what are the issues? So first question, what is the trade-off between carrying a large cash balance versus a small cash balance? That is carrying cost versus shortage cost, right? Having keeping more money in our hand is good or bad? So keeping more cash, it means we are maintaining high liquidity, more than enough. Is it good? Is it good to a company? Why? finance students, please answer my question. Keeping more cash in our hand, additional money in our hand, is beneficial for us or is a bad decision?
No, sir, it is not benefit because there is inflation.
No, the ultimate objectives of the business people to maximize their wealth, isn't it? So say for example, they want 50,000 to run their business, but they are keeping 500,000. So they are keeping 450,000 as an additional money. If they put their money into the bank, they can get what? They can get what?
Interest.
Interest. So if you keep more money in your hand, you will lose the interest income from that investment. You can use that additional money to make any other businesses, right? And right. So if you keep more money, you will lose your investment income, your income, isn't it? Right. Then if you are keeping money less amount, small cash balance in your hand, say for example you need 50,000 but you are keeping in your hand 20,000 or 25,000, is it good or bad? It's a good or bad practice for the organization?
Bad.
Because they are unable to meet their daily obligations, day-to-day obligation, they are unable to meet. Therefore sometimes they forced to bankruptcy, right? So the cash management is about maintain an optimum balance in their hand, not more than enough, not less than enough, right? We have to have an organization should keep enough and sufficient money in their hand. So it's about carrying cost versus shortage cost. So if you keep more money in your hand, it will generate opportunity cost, that is carrying cost. And also you have to keep the money in a secure way. So it also increase another cost, right? You have to keep the money safely. So you will have carrying cost. And if you are not maintain enough sufficient money in your hand, you will face shortage cost, right? So what is the proper management of cash balance? So to find out the optimum cash balance, we can apply two models, BAT model, Baumol, Allies, Tobin. Baumol, Allies, Tobin model. It's like an EOQ model in inventory, and Miller and O model, Miller O models, right? And right, have you remember this kind of graph in inventory management? Have you remembered? Cost of holding, cost of order. Have you remember? When you calculate EOQ, when you maintain inventories in your hand, there will be two major costs. First one is cost of holding. The second one is the cost of order. The same principle will be applied for cash management also. Here, when you keep more money, here in the graph, you can observe in the vertical axis, the cost, right? The cost in rupees of holding cost. And in the horizontal axis, you can observe is what? Size of cash balance. Size of cash balance. And right, when you keep more money in your hand, when the size of cash balance increases, you are encountering with opportunity cost. You will lose your income, investment income, right? So when you keep more money in your hand, the cost of holding cash increases, right? But in other side, if you keep a less amount of money, you will lose what? So you have to face shortage cost, isn't it? You will lose shortage cost. And shortage, for example, ordering cost, right? Here trading cost mean, so if you keep more money, then you deposit the money, you buy the some financial instruments like treasury bills. If you have additional money, you can buy treasury bills, right? Then you can get some sort of interest as an income. But suddenly you need money, then what we have to do? We have to convert the securities. We have to convert the treasury bill into cash. And when we convert the securities into cash, there are some cost. There are some cost associated with that. When the number of transactions has increases, the cost of trading cost will increase, right? And when we are keeping more money in our hand, we can reduce the trading cost. Trading cost means we convert from cash, we convert the financial instrument like treasury bills, we convert treasury bill into cash, transaction cost, right? That is a trading cost. As a financial manager, we don't want to keep additional money, and we are not encountered with shortage of money. No surplus, no deficit. We have to play in the middle, right? So this is the midpoint. This is the midpoint. The total cost includes both opportunity cost and trading cost. It's been cost of holding cost and cost of trading cost, right? Carrying cost and trading cost. This is the total cost. Here, the opportunity cost and trading cost are intersect at this point, where the total cost of holding cash can be minimized. So it's the same principles as inventory management, EOQ model, right? And right, and we move to right. This is BAT model, Baumol, Allies, and Tobin model, right? Here, in the vertical axis, the cash balance will be figured out. In the vertical axis, we will figure out the amount of cash balance, and the horizontal axis, the time. It may be in terms of days, weeks, months, and so on, right? So we, at the initial point, we invest our money. In this example, we start our business with 2 million rupees. 2 million rupees. This is what the maximum level, maximum point. We start with 2 million point. When time passes, we are using cash, and step by step, the cash balance going to reduce, and it will reach a point, and where we start to trade. We start to convert our securities, short-term investment, into cash, and once the cash balance comes close to zero, and we start again with the initial amount. So it continues forever, and we have to maintain average balance, average cash balance. It is not surplus money, not deficit, right? So we have to keep average money. So our target from the BAT model to calculate average cash, optimum amount of cash, right? So we have formula It's like it's very similar to EOQ formula. Same principles applies here. And this model having two assumptions. So when these assumptions are violated, we can't apply this model. Here there are assumptions. So first one, the cash is spent at the same rate every day. For example, if you are spent every day 50,000, so tomorrow and after tomorrow, or the whole all over the period, you will spend the same amount, 50,000, right? The constant rate of spending money. And the cash expenditures are with certainty. You can estimate the future cash outflows, expenditures with certainty. There is no space for probability, right? The certainty principle will be applied here, right? The optimum case balance. The optimum case balance is where the opportunity cost of holding cash, it's mean the foregone cost when you make so when you keep money in your hand, you will lose your investment income. So that is we consider as the opportunity cost of holding cash. So how do we calculate cost of holding? So cash, optimum amount of cash divided by 2, and we will get the average cash balance, and we multiplied by the rate of interest in the bank, or the rate of return on that securities. And a trading cost. So when if you want more money, you have to convert the finance instrument into cash. So the optimum cash balance is where the opportunity cost of holding cash and trading cost are equal, right? Opportunity cost of holding and trading cost are equal. How do we calculate trading cost? So number of transactions, and here the T is mean the total cash requirement. In EOQ, it is equal to the annual demand for inventory. Here annual demand for cash, T, right? And C is opportunity C. So optimum case balance like EOQ, right? C equal like EOQ. And F is a transaction cost of order like in EOQ, right? It's very simple. So in the when you take EOQ formula here, EOQ equal 2D. 2D means 2 into annual demand into cost of order, and you should divide by the cost of holding, and we have to get the root of that value. And the same principle here 2, T is annual demand, annual requirement of cash, or monthly requirement of cash. So the time, right? It may be annual or monthly or quarter, whatsoever of your interest. And F is a fixed cost of making securities trade to refill cash. It means to refill cash, to convert from security to cash. So how much you are going to spend for every transactions. So that is denoted by the letter F. And R is the opportunity cost of holding cash. In inventory management, we keep as cost of holding of inventories, but here we have to take the opportunity cost of holding, right? The interest, normally we take the interest rate on marketable securities. And this is an example, right? This is an example. The finder company faces a fixed cost of 4,000 to obtain new fund. So transaction cost is how much? Per transaction cost is $400. Not $4,000, isn't it? There is a requirement for 24,000 of cash over the each period of 1 year, right? The cash requirement for the year is 24,000. It is last for foreseeable future. The interest cost of new funds is 12% per annum, right? If you invest your money into a bank, you can get 12% of interest as income. The interest rate earned on short-term securities is 9%. Sorry, here the interest cost. It means if you want money, right? If you get overdraft in a bank, the bank will charge you 12% per annum interest rate. You have to pay 12%. And if you keep money in a bank account, if you invest that money in securities, you will get 9% per annum. Then how much opportunity cost? How much opportunity cost? Here, cost of holding?
3.
3. Good. How we got a 3? So please understand very carefully. If you have surplus fund, you can invest that money at 9% interest rate. At the same time, if you are encountered with cash deficit, you have to get the money from outside or bank or any other sources. At that time, you have to pay 12% as interest expenses. So the opportunity cost, holding opportunity cost is how much? What's the percentage? 3%. 12% minus 9%. When you keep money in your hand, you will lose 3%, right? Then so we already calculated the cost of holding of cash, that is equal 3%, right? And annual demand of cash, how much? Annual requirement equal 24,000, and we have to put 2 as in the formula. And the transaction cost of order 4,000. Then when we solve this equation, we will get 80,000 as an optimum cash balance. If you keep money more than 80,000, you have to invest that money in other securities. And if the cash balance goes below 80,000, we have to get money from the bank or any other sources. The optimum amount of new fund to raise is 80,000, and this amount is raised every how many times in a year? How many orders here? They have to keep the money 80,000, but the annual demand for a period they are 24,000. And so they can keep the money for 3.33 years. 33. So every 3.33 years they have to convert the securities, right? And so there are 2 examples. Do you have any lectures at 10 o'clock? If not, we will continue. Do you have any lectures at 10 o'clock?
Yes, sir, we have.
Then we will continue from tomorrow, and I will send you